Well, I was wrong. In fact, I was dead wrong about interest rates. Over the past year, I've stood in front of many, giving multiple presentations, passionately arguing that by the end of May or middle of May, and certainly no later than the end of summer, rates would drop. Here we are, the sun is setting on another summer, and what do we see? Mortgage rates hitting a staggering 20-year high, getting close to that 8% interest rate. In one aspect, I was right on target. Housing values, they've continued to soar just as predicted. But this combination, skyrocketing rates alongside peak housing values, it's turned the dream of homeownership into an affordability nightmare for so many. Stay with me as we dive deep into how we got here, where we might be headed, and let's demystify the unpredictable world of mortgage interest rates. Hey everyone, before we continue, if you're finding this content valuable and want to stay updated on the latest insights, do me a favor, hit that button below. It truly helps the channel grow, and if you haven't already, make sure you subscribe and click the notification bell so you never miss out on our deep dives and analysis. All right, let's jump right back in. We're going to dive deep into the intricate dance of the economy and mortgage rates. Historically, when the economy dips into a recession, mortgage rates seem to thrive. Why is this? In times of uncertainty, volatility, and turmoil, investors instinctively seek refuge. They're looking for something stable, something secure. Enter bonds, the economic safe haven. As demand for these assets grow, their prices rise. But this is where it gets interesting. Bond prices and yields share an inverse relationship. As prices shoot up due to heightened demand, yields take a dip. So given the circumstances, my hypothesis was solid, or so I thought. All signs pointed to an economy on the brink, pretty high profile layoffs, mounting debt, shrinking savings. Everything seemed to be in line with the idea that our economy was teetering, if not already on life support. But then the unexpected. January's employment report released in February threw everyone off guard. And that's when I realized the dance between mortgage rates and the economy was about to shift its rhythm. While all these economic signals were flashing, there were a slower pace of inflation. Now, let's not forget about the global stage. During this period, there were mounting tensions between Russia and the USA, and history has taught us that when geopolitical unrest brews, money tends to find its way into those safe havens, aka bonds. So again, bonds emerge as a sanctuary for nervous investors during times of international turmoil. They're predictable, stable, and secure. So with all this information predicting a drop in mortgage rates wasn't just a shot in the dark. It wasn't mere speculation or frankly, wishful thinking. It was rooted in years of historical data, established trends, and patterns we've seen play out time and time again over the decades. Yet, as we've seen, the market had its own plans. And sometimes, no matter how much data you have, there are forces that defy expectations. As I look a little bit deeper and try to figure out where my mistakes were made, I'm looking at the current landscape, and certain anomalies started to emerge that deviated from the historic norms. First and foremost, the banking sector. There were some strange activities taking place that disrupted the typical correlation between interest rates and inflation. The Fed, a major player in this story, embarked on a trajectory of hiking the overnight lending rate. It stands now at a staggering 5.25%. This action cascaded into our prime rate soaring to 8.5%. Most consumer debt hinges on this prime rate. As it escalates, so do the interest payments, chipping away at consumer saving. Yet surprisingly, the average consumer has remained steadfast. But I'll confess, I had anticipated the strain to manifest sooner, perhaps in the form of decreased consumption, perhaps. Yet among all these factors, there's one largely overlooked and is perhaps the most impactful on interest rates are our banks, especially the regional and community banks. Now, I'm no accountant, but here's a concept that's crucial. As yields spike, bond prices plummet, and there's an accounting term called mark to market. It means assets like the bonds held by banks need to be valued at their current market price. Here's the twist. Banks must have reserves, typically about a tenth of their outstanding loans. With bond prices tanking, many banks found themselves below this threshold. Their solution? A frantic fire sale of mortgage-backed securities, among other assets, which were flooding the market with supply, pushing bond prices even lower and yields even higher. This whirlwind of events, some predictable and others blindsiding, has reshaped the understanding of the relationship between mortgage rates, inflation, and the broader economic trends. In the midst of the financial chaos, a familiar hero emerged on the horizon. The Federal Reserve. Historically, when the financial seas get stormy, the Fed has been the beacon of stability. And although the Fed was in the process of actually trimming down its balance sheet, which, by the way, was adding even more supply to the fixed income markets, but this was anticipated, it swiftly shifted gears. The Fed has a special role, acting as the lender of last resort. When all other avenues close, they step in. But for the banks, this is the one call you never really want to make. It's a financial equivalent of sending out an SOS. There's a stigma attached to it, a public signal that you've exhausted all your options. But the Fed did more than just lend a helping hand. They cranked up the printing presses, and suddenly the M2 supply, which had been on the decline, saw another spike. And this uptick in M2, well, it's inflationary. And true to their nature, what did mortgage rates do? They responded in kind, trailing the upward path of inflation. It's a dance of intricate steps, each player moving in response to the other. The ever-evolving relationship between the Federal Reserve and the banking sector, inflation, and mortgage rates is a testament to the dynamic nature of our financial ecosystem. But the equation got complicated. Community banks were in a tough spot, rushing to release a flood of mortgage-backed securities. Why? To gather capital. We talked about that. They needed it to maintain liquidity and satisfy those crucial reserve requirements. And then on top of all of that, entered in the loan level price adjustments, which were actually announced early in the year, but kicking into gear by the second quarter of 2023, or in the second quarter of 2023. Now, these adjustments touch almost every conventional, in fact, they touch every conventional loan out there, but FHA followed as well. Factors like credit score, loan to value, property type, residency all determine an adjustment. And surprisingly, the better credit scores felt the pinch more. The rate hikes were steeper for them, while the lower credit scores faced less severe adjustments. But there's another twist. Amidst the whirlwind of economic influences, government intervention added another layer with the purported goal of aiding affordable housing. Interest rates saw a bump. And what I would say the common thing to do is anytime the government has a plan and that has a title, like the Anti-Inflationary Act or Affordable Housing Act, just put the opposite of it, and that is exactly what will come out. So affordable housing will end up being non-affordable housing. Anti-Inflationary Act will be Inflationary Act. There's this popular myth. When the Fed hikes interest rates, it immediately impacts mortgage rates. But as we've discussed earlier, it's a bit more nuanced than that. Mortgage rates follow inflation, and during COVID, the Fed stepped in, becoming a significant buyer of mortgage-backed securities, keeping these rates, mortgage rates, artificially low. Had the Fed let market forces play out sooner, we might not have seen such a surge in housing values or a sharp interest rate correction to combat the soaring inflation. Enter moral hazard. There's this belief now that the Fed will always swoop in, keeping rates low and housing affordable. But market dynamics have other plans. Low rates spurred a buying frenzy, leading to a reduced supply and skyrocketing prices, exacerbating the affordability crisis. Many expect these low rates as the norm, but history tells a different tale. With the Fed offloading its assets and selling mortgage-backed securities, bond prices tumble and yields rise. Everything from homes to your daily groceries is pricier. As debts surge and savings are reduced, the storm clouds gather on the economic horizon. Will there be a housing crash, as many predict? Or will the fundamental rule of supply and demand stabilize values? Transactions have already taken a gigantic hit. Few and far between. I've been in this industry for over 2 decades, and the correlation is clear as day. As rates climb, transactions drop. This past summer, a seasonal spike gave us hope. But will it last? Or will we see a dormant last quarter reminiscent of the previous year? The mortgage landscape is shifting, and the journey ahead is uncertain. By understanding these dynamics, this gives us a compass in these turbulent times. And that, my friends, brings us to the end of today's deep dive into the world of mortgage rates and the broader economic landscape. Knowledge is power, and I'm glad you joined with me today on this journey. If you found value in this discussion, do me a favor. Hit that subscribe button below, join our community, and let's navigate these financials waters together. Thank you for your time, your trust, and for being part of the community. Until next time, take care and keep asking those crucial questions. I'll be right here to help and have any discussions that you want. That is a guaranteed discussion. Have a great day.